and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast.
Yeah, thanks, Push.
We truly appreciate your time and insights as we explore critical topics shaping the landscape of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely Treasury plan to boost working capital effectiveness and organizational resilience, US inflation data priming markets for an interest rate cut in September, or will there be a rate cut on July 31st? Japanese chipmakers plan US $30 billion investment in semiconductors, and finally, Saudi Aramco begins issuing US dollar-denominated bonds. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Paul, let's begin today's discussion with our first story, which focuses on how Treasury can develop a plan to strengthen working capital management and bolster business resilience. There are several triggers in the market that are acting as potential catalysts for change within business and treasury departments. Some of these triggers are opportunities for treasurers to harness notably the ever more affordable range of treasury technologies. Others are threats to be managed, not least the volatile geopolitical climate and uncertain interest rate environment, according to the Association for Financial Professionals, or AFP's Treasury in Practice Guide, adding certainty to working capital management, underwritten by Wells Fargo Bank. Beginning with a review of macro themes that are driving change within organizations, this guide proceeds to explore various tools treasurers can leverage to strengthen working capital management, thereby making businesses more resilient amid financial and geographical uncertainties. Factors vital to effective working capital management not only include liquidity, but also the funding of the business, the resulting cash flow from operating activities, and cash velocity. Importantly, the net trade cycle is also a factor. Balancing these various factors and the relationship between them is the art of effective working capital management, as stated in the AFP guide. The AFP guide recommends 4 critical approaches to help Treasury develop a plan to boost working capital effectiveness and organizational resilience. Paul, you're an experienced Treasury consultant. Can you please walk us through a couple of the key measures or approaches outlined in the AFP guide that you think can help Treasury teams formulate a plan to boost their organization's resilience through the optimal use of working capital?
Yeah, Push, there's a lot of really good content in this article. So if people haven't had a chance to read the article on CTM File, certainly go out there and read this. Good content for sure. So when you think about working capital management, what comes to mind is cash conversion cycle and access to liquidity. Those are the 2 key items that I think of when it comes to working capital management. So you have revenues, you have payables. You're looking at how quickly you can get revenues in the door and how you can manage or extend your payables so that you can utilize that working capital to do other things, such as grow the business on a daily, weekly, monthly basis. And so treasurers are constantly working that balance in conjunction with demands by business unit leaders and product developers and all their customers that have a demand for their particular product or service. So we think about those 2 things as kind of the key aspects, and this article really kind of dives into those things. But one of the things that it draws out at the beginning is around the forecasting aspect. And so forecasting is becoming more and more important for treasurers and treasury departments and just organizations writ large. So you've seen a huge growth in FP&A teams within companies. They're closely knitted to the CFO, business units, and the treasury team. They all work in conjunction to develop forecasts and utilize forecasts for making decisions. So you need to have a really good forecast for a liquidity standpoint to understand what you anticipate for your cash flows, what they're going to look like. Are you going to have enough to meet the demands at the particular time and place? And so you need to have a strong, thorough forecast in place and something that's reliable. Anybody can put a forecast together, but if you don't have good data content going into your forecast, you're not going to make good decisions because your forecast won't be good. So always I like to think of it in terms of, I want my forecast to be in the fairway. As long as it's in the fairway and not off in the rough or, God forbid, on another hole, then I'm feeling pretty good. So I want my ball in the fairway. You want that with your forecast. As you learn things using technology to help you with forecasts, artificial intelligence, machine learning, your FP&A team, your business units, all these things can come together to help you make better estimates of how you think things are going to move. And you got to take into content the things that are happening outside the organization that can have an impact. Maybe it's your supply chain. Maybe it's geopolitical aspects, it's economic aspects, it's things that are driving demand by your customers. These all come together to inform and impact what your forecast might be and help you as a treasurer for decision making. One of the other things that this article does a really good job of is explaining what kind of the three core aspects to working capital that are important. Your DSO, your days sales outstanding, your DIO, which is your days inventory outstanding, and your DPO, which is your day payables outstanding. And so your forecast can help you understand this. Historical data helps inform in understanding what the trends look like. Your FP&A team can help you with those things, but monitoring these three key aspects also helps with working capital management. And this article does a nice job of laying out those three key pieces, how they function, how they work. So as a treasurer, you do need to understand those aspects. There are some organizations where some of these particular pieces may not be as informative as others. Manufacturing, retail, those kinds of business lines, they tend to utilize those quite a bit. When you take an insurance company into factor, insurance companies really don't have working capital, and so it's a little bit different view. But does it mean that those particular items aren't important from a liquidity standpoint? Because even insurance companies have liabilities that they have to work with. So you can kind of take that and put that in place of perhaps your payables. What are you going to pay out to your customers that have bought products from you? Life insurance policies, annuities, those kinds of things. So these particular aspects, I think, apply to a variety of industries, perhaps in different ways. And so that's the point I'm trying to make. As a treasurer, you need to understand those aspects. What would impact the net working capital that you have in place? And so you need to have a plan, though, for when things might change. This article points out that particular aspect. And so it's having that ability to be flexible when things turn on you. It could be the macroeconomic items or geopolitical or just customer preferences. And organizations that have the ability to be nimble or flexible can win the day in those instances where things don't exactly pan out the way you anticipate and they change, and you might have to pivot to keep the business moving in the right direction and meet the needs and demands of your customers. So I think overall, when it comes to working capital management, treasurers just need to understand they have more than one tool in place to help them with being effective and optimizing how you utilize and how you get access to liquidity, because liquidity at the end of the day is what a treasurer needs when demands are put in place on working capital.
Thank you, Paul, for taking us through some of the primary methods outlined in the AFP guide that Treasury teams can use to improve their organizational resilience through effective working capital management. That was an insightful analysis. Let's switch gears to discuss the second topic, which is about the US inflation data priming markets for an interest rate cut in September. The latest US Consumer Price Index showed that headline inflation rose 3% for the 12 months ending June versus a consensus expectation of 3.1%. It was a smaller increase than the 3.3% increase for the 12 months ending May. Core CPI rose 3.3% over the last 12 months, the smallest 12-month increase in that index since April 2021. Notable contributing factors in the latest inflation data include the index for gasoline falling 3.8% in June after declining 3.6% in May, more than offsetting an increase in shelter. The energy index fell 2% over the month, as did the preceding month. The index for food increased 0.2% in June. The food away from home index rose to 0.4% over the month, while the food at home index increased 0.1%. Daniel Caselli, chief investment strategist at wealth manager Evelyn Partners, commented, "Given this benign inflationary backdrop, the Fed could well cut interest rates by a quarter point at its 18 September Federal Open Market Committee meeting, as now expected by the Fed futures market. There is even the potential for the Fed to cut interest rates sooner, possibly at its 31st July Federal Open Market Committee meeting." Paul, do you think that Fed will cut interest rates at its upcoming policy meeting on July 31st, or do you think the groundwork will be laid at the July 31st meeting, setting the Fed up for reducing rates in September?
Yeah, Push, I don't put a lot of money on the line that they're going to make a rate decrease in July. I don't see that happening. I think there's still plenty of unknowns. Chairman Powell, has said, well, we're starting to see some of the things we want to. Today we had retail sales come out. Retail sales were higher than what the estimates were. So I feel like we're still seeing some conflicting data and information out there. And so I feel like this Fed is going to continue to monitor what those key economic indicators are and not make a move for July 31st. That would give them a couple more months of data to come in to determine, does a September rate cut make sense? I know the markets are out there. When this data came out, bets were extremely high for a September rate cut. In some instances, economists out there are expecting maybe 3 rate cuts. I don't think 3 feels like the right number to me at this time. I think that's rather aggressive. We want to see consistency in the data. So if over the next couple months we see consistency in data that indicates that jobs are oscillating in the right direction, that we are seeing inflation tampered down and maintaining tampered down, the CPI is certainly a big headline item, and it could push a decision one way or the other if it continues to be consistent, even if we have other economic indicators that might be contrary to it. So, my eye is going to be on CPI. I'm still going to keep an eye on jobs. I do think the consumer will have a big play in terms of the strength of the economy. And so for the Fed, it's key to have the right timing. Now, the Fed has historically not always done a great job on timing, either cutting or raising too soon, too quick, or too slow. It's gone both ways, and it's come back to bite the economy. So, it's trying to time that and get it at the right point. This Fed feels like they're really keeping an eye on the timing. When I think about now to September, I think we're going to get enough information in place where a decision could be made in September. I would say it's definitely higher than it has been. It's not definite by any means. You asked me the last time, which was several weeks ago, and I was still of the opinion that we wouldn't have a rate cut until fourth quarter of this year. That still could hold true. We'll see what happens in September. It may not happen, and it could happen, more like October, November. It all depends on where the economic indicators come in. And I just haven't bought in that the Fed is ready to make a cut here in July. So I really, really don't see that happening. That would be a surprise to me. Perhaps to some economists and some people in the markets, it would be very welcomed and not so much a surprise. But for me, July 31st just doesn't feel very realistic. September has a much higher probability.
September has a much higher probability. Well, Paul, thank you for sharing your valuable perspective. Let's now shift the conversation to the third story, which is about 8 Japanese companies, including Sony and Mitsubishi Electric, planning to invest 5 trillion yen or $30 billion in semiconductors in response to the growing opportunities in artificial intelligence, electric vehicles, and the carbon reduction market. The investment is expected to increase the production of image sensors, power semiconductors, logic semiconductors, and other products. The 5 trillion yen investment will be made over the period to 2029, driven by the optimistic outlook for the AI and carbon reduction markets. A report compiled by Nikkei surveys the equipment investment plans of 8 major Japanese semiconductor manufacturers between 2021 and 2029. These are Sony, Mitsubishi Electric, ROM, Toshiba, Kioxia, Renesas, Rapidus, and Fuji Electric. Japanese semiconductor companies reportedly held a 50% global market share in 1988, but after the 90s, they lost the competition to Taiwanese and South Korean manufacturers, leading to their withdrawal from advanced process research and development in the early 2000s. By 2017, Japan's market share had fallen below 10%. But around 2020, as US China trade tensions heightened, the Japanese government designated semiconductors as a critical material for economic security. Paul, from a multinational corporation's perspective or a global tech company's viewpoint, does Japan's comeback in chip making or its chip reboot strengthen the global semiconductor supply chain?
Yeah, Push, you and I have had multiple conversations around supply chain, and we've seen trends where organizations are diversifying, which I'm a proponent of. Diversifying your supply chain, I think, helps ensure some level of security versus having one particular area supply the majority of what you utilize to produce or manufacture products and goods. I think having Japan jump back into this market, which I think one could definitely argue that they should have never jumped out. That was a mistake on their part. But them jumping back in, I think, is a smart move on their end. Of the three that are listed here, the one that I think has probably got the biggest upside is the artificial intelligence. I think that has the greatest upside. Electric vehicle market, what I think I've seen with that market is, in particular in the US, is it's really kind of slowed down from a growth perspective relative to what it was. It doesn't mean that adoption isn't going to continue. I think you'll see adoption continue over time, but at a slower rate. Carbon reduction market, there's definitely opportunity there, but that feels more like a slow burn as well compared to artificial intelligence. I think this is where the greatest growth is going to be. So, jumping into the market at this time really kind of makes sense to me. So I think having the ability to go to more than one manufacturer, because there are manufacturers, diverse locations within the world. Obviously, certain areas are king right now, but I think you're going to see more and more of a move or a strategic play where countries are going to take advantage of or the opportunity to enter this particular market, and certainly an area that the U.S. has a focus on, especially with the saber rattling by China over Taiwan. I think there's a lot of risk associated with the potential, which you've probably heard that out there before, that China may overtake the country and take control of the manufacturing that occurs there, in particular semiconductors. This is certainly a strategic play for China, certainly a strategic play for the U.S. as well. So that is a hotbed for sure. If other countries jump into semiconductor manufacturing where China would have less influence or potential to disrupt and control, I think that's better for the supply chain. So I think this is very welcome news.
Paul, you've raised some interesting points. Let's explore now the fourth story, which is about the energy giant Saudi Aramco, which has begun issuing US dollar denominated international bonds under its global medium term note program. Aramco stated that the bonds have a minimum subscription of US $200,000 with the offering price and value determined based on market conditions. The offering began on 9 July and is due to conclude on 17 July. The issue marks the state oil firm's return to the debt market after a 3-year hiatus. Gulf companies and governments have been eager to leverage debt markets this year amid declining global interest rates. Aramco stated that its US dollar denominated bonds are direct, general, unconditional, and unsecured obligations of the company. The bonds are aimed at institutional investors, specifically qualified investors in jurisdictions where the offering complies with local regulations. The issuance is managed by Citi, Goldman Sachs International, and HSBC. JP Morgan, Morgan Stanley, and S&B Capital are also participating as active joint book runners. Globally, Saudi Arabia has emerged as the leading issuer of international bonds among emerging markets, surpassing China with US $33.2 billion in bond sales to date, as reported by Bloomberg last month. This marks the first time in 12 years that China was displaced from the top spot, driven by an 8% growth in Saudi Arabia's bond sales this year, according to Bloomberg. Paul, if you were a corporate treasurer in the energy sector or had business operations in the Middle East, how would you view Saudi Aramco's move to issue US dollar denominated international bonds, particularly in light of the kingdom's record pace of borrowing driven by increasing support from global debt investors for the nation's Vision 2030 plan, which aims to diversify the Saudi economy away from oil dependence and transform the country into a global business hub by the end of the decade?
Well, Push, this really makes sense for Middle Eastern countries that are oil rich to take the wealth that they've accumulated from oil and redeploy that. We've seen that with Saudi Arabia, Dubai, Kuwait, other countries. They have been doing this, and in particular when it comes to being a global hub, we know that Saudi Arabia and Dubai have been huge influencers in these arenas, and it's going to continue to be that way. So this is not necessarily a surprise that that they're jumping back into the bond market, and the use of leverage to help deploy capital in a more efficient way is certainly a smart move as well. So, and it's really a very small piece of the overall pie when you think of it. I think it's less than 1% of the total business that this represents, so it's a relatively small piece. But nonetheless, the use of leverage, I think, just makes sense. If I'm Saudi Arabia and I'm wanting to take the cash pile and make it bigger and be able to have an influence and attract investors to the Middle East as a conduit for making these types of investments, this is a way that they need to go. They got to start going this direction. This particular issuance, there's a lot of complexities. The article makes it sound like it's relatively benign, but there are puts and calls associated with this. There is some recourse in the instance of that the business is not behaving the way they intend. So, it's got some levers in there on both sides for the investor and the issuer in the instance that interest rates move or the business changes. So these are things that aren't necessarily uncommon, but it's not just a plain vanilla debt issuance. It's not something that, hey, we've got some covenants around it. It's relatively plain vanilla. So I think what we're seeing here is that the sophistication of what they're engaging in is going to continue to step up and become more robust. And if you're going to be a financial hub in the Middle East, that's what you need to do. So you got to demonstrate that you have the capabilities and the risk appetite to make these types of issuances.
Thank you, Paul. I really appreciate your thoughtful analysis. Finally, what is your choice for the biggest or most important story of the past week and why?
Yeah, Push. The biggest story of the past week is pretty easy to call out. the attempted assassination of President Trump, former President Trump. You say it either way. I think that was really a significant event that occurred. The reason that is significant is because we're going to be electing a new U.S. president, or not necessarily new. There's going to be an election this fall, and that certainly has an impact not just on the U.S. but globally. And so our partners and our adversaries are watching this very closely. And I think that this assassination attempt actually turned out to be really good for Trump's campaign coming off of President Biden's debate debacle. Trump was quiet until this event happened over the weekend. So I think, it's really changed the dynamics of the race. And so it's going to be really interesting to see how that charges up the base for the Republican Party, what that might do also on the flip side for the Democrats, and whether we're going to continue to hear calls for Biden to step out of the race and for somebody else to be put in to go up against Trump. That still could happen potentially. I'm not a political analyst, but just thinking about potential things that could happen, that still potentially could happen. So from a perspective of being a partner with the U.S. or being an adversary, it's really kind of changed the dynamics quite a bit. And obviously, a U.S. president coming into office, especially if it's not the incumbent, they tend to change policies and direction of how things are going to be run in the U.S., as well as how relationships globally are going to work. And Biden and Trump have differing views on many things. There are some things that are somewhat aligned, but there's definitely a difference in how they'll manage those relationships. So, I thought that was a pretty big event that occurred.
Well, as we conclude this episode, I'd like to take a moment to thank you, Paul, for joining us. Your expertise brought depth to the conversation today. We also want to express our sincere appreciation to our CTM File audience for tuning into this edition of the Open Treasury podcast. Please subscribe to our podcast and check out the show notes for links to the articles discussed. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.